at Abacus Manager LLP, joining in on the show to talk about exactly that. Sunil, hi, morning. Good to have you on the show. Sunil, what does an Indian investor do? Here you've got that tussle with the US right now. Now you've got an additional 25% tariffs on us since yesterday. And domestically, the government is doing all that it can to try and fill up consumption. How does an Indian investor, in their minds, balance both these curves?
No, so I think you're right. It's been very sort of confusing and I would say choppy last few months. But I say if you look at the last 12 to 14 months, we have had multiple challenges, starting from a slowdown in economy, slowdown in corporate profit growth, obviously huge FI outflows going into China and other countries. And then the worst thing is this tariff uncertainty which has come in. So right from January, we have been bracing that. None of us, frankly, even expected India to have a 25% tariff. And on top of it, now we have this punitive 25% tariff coming in. All sudden, I think the economy has braced quite well. I think the government has also gone in overdrive, which normally happens, starting from the income tax relief, which we got in July, which will add up to almost 1 lakh crore for the whole year. And hopefully this GST cut, which is expected on September 3rd and 4th, which will be again a 1.5 lakh crore. On top of it, the central bank RBI governor has infused huge liquidity, almost 10 lakh crore in the system. So I think everything else is in place. Oil prices are low, currency has been pretty okay. Fiscal deficit is in control, interest rates are in control, inflation is in control. You have had great monsoons, rural economy is picking up. Now, this whole tariff thing obviously has been a big sort of a surprise. And obviously, if it continues for a long time, then whatever we can say by being brave, I think there is definitely going to be a impact. The only thing is it's very unnatural to expect India to get 50% and China and the other countries who have a higher trade deficit vis-a-vis the US at a lower tariff. So let's hope that this resolves very soon. But yes, I think this has come as a negative surprise. What we are telling our investor is that now, yes, this tariff has come and the markets have reacted. I think most of the bad news seems to be building in the price, maybe, a couple of percent here and there. But if things sort of sort out itself, which at least our base case scenario is that there's an 80-90% probability that over the next few weeks, we will have some resolution because both the countries need each other, then this is a good time to start building, positions because everything else is falling in place. And in fact, government is going on an overdrive to ensure that the domestic economy really picks up.
But Sunil, do you think this is the time to invest big the next 3 to 6 months up until when you hope for everything to get resolved, both on the domestic as well as the international front? Or would you say still keep some powder dry, only nibble into this market?
Vaisha, one is on 1 year basis now, the markets are flat. So obviously India was trading at a significant premium to the peer group, particularly, countries like China or Korea or even the emerging market. With this 1 year underperformance of almost 25-30% vis-a-vis these countries, we are now at a 10-year average premium to what we were trading at. Second is, as I said, I think there has been a huge focus on getting the GDP growth up there. And this whole impact of almost a 10 lakh crore liquidity infusion, interest rate cut, and further infusion in terms of GST cut, and obviously the full impact of income tax cut will be starting to be felt, in the second half, because, starting from September is when you have a busy period for the economy. The monsoons are normally very subdued period for doing anything on the infrastructure front or on the capex front. So our view is that the second half should get back to a level where earnings growth start to look at 14-15% plus. Now, obviously, this tariff, as I said, 50% is like, most of the sectors which are impacted, would not be able to export anything if 50% tariff continues to the US. But, as I said, the base case scenario which we are working on is there's an 80-90% probability that something will get resolved very soon. So I think from an investor perspective, there is an opportunity now because the markets have corrected. The risk of waiting is that if something positive happens on the tariff front, then you might have a period where the market might open gap up because, as I said, the negative news is significantly already built in the current correction.
Feeling is saying, Sunil, go all in.
So I've always been an optimist on India, and I think last 25, 30 years we have had multiple such issues which have caused markets to correct 5, 10, 20%. And those who have been positive on India have had great opportunities to create wealth. So I would say that it's a good time.
Okay, got that hint. Also, Sunil, your approach has always been bottom-up right now, right? But in this very well-discovered market, where do you find those bottom-up stories?
No, you're right. I think the markets are becoming more and more efficient. And I think that is what we've been taught, the efficient market theory. But in this efficient market theory, the good thing is that we are in India where, we have almost all sectors, so many listed companies, so many great entrepreneurs. Yes, you have to work hard. But, if your return expectations are reasonable, then there are more than enough opportunities which come in. And I would, just a little bit stress there because, return expectations have to be reasonable. We had a period of 4 years between 2020 to 2024 where returns were extraordinary, 30-40% CAGR in the broader markets. I think we have now to get used to more a mid-teen kind of return scenario going forward. And I think if the investor and for us, frankly, if we are looking at that, then there are more than enough opportunities which are coming up. The other thing, Aisha, is the world is pretty volatile. Markets are pretty volatile. And from time to time, like this time also, you are getting opportunities where you're able to buy something which you wanted to buy, maybe 5, 10, 15% cheaper. And that is how, if you have the conviction and if you are positive going forward, then you can add that additional 2-3% to your returns by taking advantage of these corrections.
Interesting. I'm going to come to that point in just a bit. But what's on my mind right now is this surge in IPOs, fresh paper, which continues to hit the markets. If not that, promoter fundraisers, some of the promoters offloading stake as well in the open market. How do you read this, Sunil? I know it's, case by case really, but is it a sign of froth in the market or is it a sign of just sheer deepening of the market and opportunities?
No, so I think one thing which is of worry to us also is exactly the same fact. Too much of paper, so many promoters we come across. I've never seen so many guys planning an IPO the way we see it now. Obviously, PE guys are selling large blocks of paper coming through promoters selling. And I think that is sucking up all the liquidity which is coming up in terms of fresh investment, particularly by domestic investors. So I think we have to be aware of that. The only counter to that is that, we are a growing economy and there are some good companies also which are coming and getting listed, which can be opportunities. And these are sectors which were never there or never present in India. The other thing is last 4-5 years on a net basis, FIs have not invested a single dollar in India. And, we are hoping that this might turn at some point of time. So I think if that happens, then you'll have a scenario where domestics are buying and foreign investors from being sellers turn to buyers. And I think that is that would be more than enough to, in fact, it will be good if there is more supply because, then investors will also be able to invest at reasonable valuations. But, from an investor's perspective, I think one has to be very careful of any new supply of paper. Don't get sucked into any IPO or any pref, just because there's a FOMO. Do your research properly. I don't think IPOs are opening the way they were opening. So this whole buy and sell on listing also will at some point of time not work. And, I think fundamentals are all the more important now, given that the return expectations, are lower and, the dynamic nature of the global geopolitical as well as economic scenario.
Makes sense. And very prudent advice at that also, Sunil. Sunil, also, getting back to that bottom-up story in the market, I think you were one of the first ones who read signs of peaking out within IT after that post-COVID surge that one saw, and you were like, it's time to sell IT right now. Is there now a contra play here? And is it only tactical in nature? Or do you think structurally IT can revive from here?
So, we went underweight. I hope that we would have gone zero on it. But see, India has advantage as far as IT services is concerned. The only challenge, obviously, is growth is now slowing down. Second is you have this GCC. So, additional demand from traditional clients is also lowering because those clients are setting up their own centers. And third is there is definitely a near-term small impact of this whole AI ecosystem which is developing. So I think obviously, if you are looking at growth of 3, 4, 5%, then it is very difficult to justify P multiples of 25 and 27. I think the only thing is that if this trade thing gets resolved, there might be a pop-up. But I think eventually there is also a risk that, what President Trump has done on the product side, he might also try and do on the services side. So at the margin, I would still recommend underweight IT. And in fact, one segment where unfortunately we have not invested largely because of a philosophy of not investing in loss-making companies. I think there is a lot of money going in, which is the new age companies. So, if you see month after month, large global investors are, reducing their exposure to IT services and increasing their exposure to the new age IT companies, which would be the platform companies or some of these, D2C companies on the tech platform. And maybe it's time to also look at that aspect, So within IT, I think the scenario might change from IT services to the new age IT services the new age IT companies.
I see, Sunil, FOMO playing out for you over there.
Yes, but if you look at our own habits and everyday routine, these companies have become ingrained in our ecosystem. And I'll completely admit that we have zero exposure to them, largely because we are a value conscious investor, and so far we have not seen value there.
But that's the other question, right, Sunil? I mean, we all know, like you said, they're part of our daily habit right now. You know that they're only going to get bigger from here. Structurally, yes, they're here to stay. But again, it's about how much price are you willing to pay for these companies? And where do you find valuation comfort?
So I think the good thing is that most of these companies have now also started talking about the importance of being EBITDA positive and net profit positive. So I think, definitely a few of them would also have great profits the way global companies in the US have transitioned. But let's see, I think they don't fulfill our criteria of the investment philosophy we follow. So we are watching them. I think, let's see.
Are you investing big anywhere, Sunil, right now? Or have you in the last 3 months?
So, last couple of years, we have not been pushing big investments on the listed space. But I think now we have launched a new open-ended AIF because we believe that with this time correction and price correction, it's a good time for investors to start building positions. So I would say that if in case we get correction, pharma will look pretty decent. I would continue to be optimistic on the banking and the whole financial services side. And selectively, I think metals, chemicals, a little bit of engineering, if you get some reactions, also look good. So, very, very boring, same old sectors. But incrementally, some stocks have started getting very interesting.
I was just going to come to that. Banks, Sunil, how do you read the very near term, though? Because there is clearly concern around credit growth. Yes, the RBI is doing all that it can. In how long do you think the credit cycle is going to actually ease out? And when is it that we're going to see meaningful returns? And I don't mean those select large cap banks which have given excellent returns. I mean the larger base.
So, I don't think we should now start to think that banks will grow at 18-20%. I don't think that the growth of the whole system would be that much. So if you're looking at maybe a 6.5-7% GDP growth, I think credit growth can be maybe 10-11%. And I think banks will also grow their balance sheets by that much. Maybe profit growth might be slightly higher. And I think if you're content with a 14-15% return, I think this offers a good stable opportunity. Select NBFCs might grow larger, but even within the financial services, I think there are segments like insurance or even wealth and asset management which are growing faster. And I think there also there are I would say opportunities. So I again repeat that return expectations, if they are reasonable, then there are opportunities. If you are expecting 20-30% returns, then I don't think there are too many banks who would be even close to that in terms of their growth in the balance sheet.
Sunil, do you now go company specific within the sectors that you just talked about, or do you also take very critical decisions about allocations in your portfolio, go a little higher on consumption, go a little easier on capex? Do you take that call on capex versus consumption in your individual portfolios?
So, we do definitely look at sectors and the trends. But see, ultimately, we are of the opinion that we have to buy good stocks, not necessarily the best companies. So on the consumption side, particularly staples, yes, last 1 month, a few of the stocks have moved up 10-15%, largely because for 4-5 years they did not give any returns. And there was a confluence of a positive news flow in terms of GST being cut, and now people moving to defensive, domestic focused sectors. But, they're still very expensive. You're still paying 55, 60, 70, 50p for companies which are growing at like 2%, 5%. And there we don't see any merit, though the sector might look good. But, if there is no profit growth, I don't think this prices will sustain, or maybe, they might not do anything for the next 3-4 years. So I think we have to just marry the opportunity within the sectors with, the individual fundamentals and the opportunity which the stocks present. And I think that is where we struggle, particularly in the staple side of consumption. Yes, I think if GST is cut, and now with this income tax cut also on the whole year basis going to add 1 lakh crore to disposable liquidity in the hands of individuals, there will be some uptick in consumption. But one also has to, as I said, marry it with the valuations.
And when it comes to capex, defense, power, anything that you like specifically?
I think capex is obviously going to be a good sector. Now this whole Make in India, because of this tariff thing, has taken a little bit of a breather because, particularly the export-oriented sectors like textiles and shoes and seafood and jewelry and so many other sectors which depend on US, there will be some slowdown in their capex plans. But I think eventually, India continues to be the fastest growing economy in the world. And without capex and without manufacturing, we can't aspire to be a 7 trillion, 8 trillion, $10 trillion economy. So I think definitely there will be a revival. Again, there, Aisha, valuations of some of, particularly the capital good companies, they have corrected, but they are still a little bit at the premium side. As I said, hopefully these kind of opportunities in the market will allow us to nibble into some of them. But that would be a key sector to look at, including power.
That's the perpetual problem with this market, right? Nothing really below 40x is available right now, which is quality and has growth visibility. But Sunil, great to have you on the show. Good chatting with you. Thank you so much for your time.
Thank you, and best wishes.
Okay, that's a lot of market wisdom, how to invest, how is it that you need to balance all the risks, the valuation concerns in the market right now. But yeah, hunker down your expectations at an index level. That seems to be the